Well, welcome everyone to the December 2021 webinar. I can't believe 2021 is almost over, but we felt like we needed to get this one in on small dollar investing with your self-directed IRA or solo K. And we've got Jamison Manwaring here, who I'm really excited. We've had on our podcast before. I've been on his Kiss My Assets podcast.
What was that?
Yeah, that's his podcast name. Jamison's a little, he can be a little more, we're like financial services attorneys. We got to be a little more play it safe. He can be a little more
Kiss My Assets, bro.
A little more wild in the real estate world.
You like to have fun with it.
There you go. I like it. But anyway, so I wanted to have him on today. We'll explain his background more and why. But this is a really interesting topic. It's something we've worked with a lot on clients lately who are like, man, I've got like, every investment I look at takes 50 grand. I want to buy a rental, or I want to invest in a private fund or whatever. Like they got these minimums and I got like 20 grand in my account, or I got 30 grand. Maybe I partner with someone or do a private money loan, or I could do crypto, or, you can do stocks and mutual funds, of course, but they're like, I want to do like real estate or an alternative asset or something I'm more excited about. And so we want to talk about some of those things that are out there. And this could be hundreds of thousands of dollars you invest, or millions. I don't know, but it could also be tens of thousands. It doesn't need to be,
or it could be 6 grand.
Yeah, it's true. Add however many zeros on to the end of that you like, but it needs to be more than like 600 probably. But
I'd say probably like at least a couple grand, maybe 1,000 at least.
Yeah,
so,
we'll get into it. So, all right, well, let's go over just some, legal disclaimers here. This is the part of the webinar where Matt Sorensen, the lawyer, comes out. This is the worst version of Matt. He's not fun. But he has to come around every once in a while. So I'm just going to give our disclaimer here that this is meant to be educational in nature. Jamison raises money and invests, and you could put your money in his stuff, but I don't know, invest with them, don't. It's all up to you. We just want to have him on as an expert primarily. So, but we do want to talk about his expertise and try to provide some education for everyone today on what's possible. So now lawyer Matt can go away and we can come back to fun Matt. So, all right. Well, do you want to go over some of the topics we're going to discuss today, Aaron?
Yeah. So for those of you that, registered, we always send out the invites, and, we're going to keep this pretty high level. Specifically, we'll be discussing crowdfunding, some Reg A fund investing. We'll touch on some crypto stuff. But as you can see, these are all different strategies that we feel, could be appropriate with a small dollar IRA amount that you could invest in and, do something cool. Again, you're self-directing. It's your call. So we're just here to facilitate and, help you along the way as necessary as custodians. So why don't you tell people a little bit about yourself that don't know you? There's a lot of people that don't know us on here.
Okay. All right. If you don't know, I mean, not that you need to. Yeah. Only here in this office am I a big deal. But I'm the CEO here. Aaron's the COO. Mark's the CFO. But Mark Kohler would just, ruin this webinar. I was kidding. But my book's the Self-Directed IRA Handbook, the most widely used book in the self-directed IRA industry, sold 35,000 copies. I'm also an attorney. So I can be really long and take a lot of time answering questions. I've been trained to bill by the hour over the years, so forgive me there. But I don't really practice law much anymore. I'm spending most of my time working at Directed IRA. We have a Self-Directed IRA Summit that I host every year. We do a few of those. I'm a VIP contributor, Entrepreneur Magazine, entrepreneur.com, where I've had almost between 5 and 10, somewhere around those articles go #1 on the site, which has been cool. Now, my new thing is I'm a contributor at Cryptopedia.
Yeah.
So I started with crypto in 2017 myself, my retirement account. We've been helping a lot of clients in the crypto space. And I got my first article up on Cryptopedia
pretty big deal.
a week or two ago.
Yeah.
So
it's awesome.
That's
About using IRAs.
Yeah, about how your IRA can buy crypto.
Yeah.
Of course.
So as Matt said, CEO at Directed IRA, Matt used to do my conferences years ago in the note investing space. So that's really where I cut my teeth in learning about, how somebody can self-direct their IRA, investing in real estate, investing in promissory notes, doing real estate options, wholesaling, deals. And, a lot of people use a small dollar IRA to do those things. So I still publish a newsletter in that space. For those of you that don't know, we're headquartered here in Phoenix, Arizona. I was born and raised in Dallas, Texas. I have 6 wonderful children. I'm an Arizona State alum, so go Sun Devils. And just, love real estate, lending, investing, IRAs, and, excited to have our guest, Jamison, on today. So a little bit about our company. We are a licensed and regulated trust company. Our charter is with the Arizona Department of Insurance and Financial Institutions. Did I get that right?
Yeah, that's their new name. They got a new name.
Yeah,
it's the banking department, basically.
Yeah. So, we are audited, have an outside examination. And, but I think out of all the things that we have on here, besides your book, of course, is that our highest rated for customer service. We just nail it with processing time and the customer service that we deliver. Jamison, sends a lot of clients our way that invest in, his various funds. So, it just speaks for itself. And, if you don't believe us, go read all the 5-star reviews that Google has. If they're verified, then good.
Mm-hmm.
There's lots of things that you can do with a retirement account. We just put that up there as a frame of reference, so you can just go back and see it. Some of these items we'll touch today, but there's lots of cool strategies that you can do, along with a bunch of different account types. One thing that makes us a little different than some of our competitors and a little unique is we have just so many different account types that you can use and self-direct. So
yeah.
Anything you want to hit on that?
No.
Pretty good. All right. Let's rock and roll with Jamison.
Okay. All right. Well, Jamison, let's just start with the first most important. He's a University of Utah grad. Go Utes. Pac-12 champions.
Yes. Going to the Rose Bowl.
Yeah, baby. So, but Jamison, one of the reasons I've had him on our podcast before is he was an analyst for Goldman Sachs. Looks like, I didn't know this, participated in 12 software IPOs. He was VP of Investor Relations at LifeLock, which is a publicly traded company headquartered out of Arizona. And what he's doing now is real estate. And James, why don't you kind of tell us about, I remember your story about going from Goldman Sachs and being kind of on Wall Street, but investing in real estate and starting to get into real estate.
Yeah, thanks for having me on, Matt and Aaron. And it's a interesting story because most of my friends are still on Wall Street, and I think they're a little envious of what I'm doing now because real estate's been such a fun field for me to be involved in. But when I was in New York, I was looking for some real estate for some tax reasons, and my dad's a real estate broker in Idaho, where I'm from.
Yeah.
And he said he came across a listing that I might be interested in. It was a small 10-unit building in Idaho. And I started running some financial models, as you're prone to do as an equity analyst on the building. And, I had a huge model that I would analyze public companies with for this little property. And it was really fun because it was different. And I started looking at it, and it just started making sense to me that I should probably do this deal. So I ended up buying it, living in New York. The property was in Idaho, doing a little renovation, finding a management team to run it for me. And I really loved it. And it was just kind of on the side. And then around that, a little later, I ended up getting a job from LifeLock to come out to Arizona to run their investor relations, basically working with all the Wall Street folks internally at LifeLock, and love that. And a short time later, only 18 months later, we got bought out by a big California security company, Symantec, Norton. And now the company's name's LifeLock Norton. Norton LifeLock, I think, actually is the order. And when that happened, I'm a pretty simple guy, and I got some equity cashed out and those types of things. Then I sold that building around the same time. And I really just had the opportunity to say, what do I want to do? Do I want to stick in equities and in software and technology equities, or do I want to do something else? And I had loved the real estate side of things so much with that building that I decided to spend a few months and do that instead. And long story short, I ended up moving for the summer down to a little Mexico town south of Phoenix, renovated a property there, turned it into an Airbnb, which I still have, and it's been a great property for me. And after I did that, I said, I'm done with equities. I'm just doing real estate from now on. And that's the long and short of it.
And this property is on the beach too. I mean, that had to help.
Yeah. And, in New York, the beachfront property is, really expensive, and it's not even that nice. So coming out west and you can get a beachfront property in Mexico and drive there on the weekends was just a dream for me. And it's been a great little property for me from a passive income standpoint.
Now, I stayed at that property. I took my family down there.
That's right. I hope you give us a good review.
Those Airbnb reviews are critical.
Yeah, they're super critical. We had a good time. Real good time.
Great. I basically came to the same point that you guys started out with, where I could go raise money from what I call the country club crowd, and try to find 15, 20 folks who had some deep pockets and start doing some more real estate deals. And I was more interested in going to a different market. My family, my parents are more working class folks, and I wanted to open up the commercial real estate asset class to a broader group of folks, because typically you either have to be an accredited investor, which means you have $1 million net worth or make $300,000 a year, or you may have a $100,000 minimum investment to get involved in these types of deals. So it's really a small group of folks. And kind of going to this slide, some crowdfunding laws were passed as part of the Jobs Act in 2012. And then they slowly were finally implemented by the SEC in 2015, 2016. But it basically gave people like me the ability to raise money online for projects like these that are real securities.
Yeah. And it gave people the ability to invest, that it's like, you don't have to be a millionaire or make 300 grand or more a year. You can have a $500,000 net worth and make 100 grand a year. You can make 50 grand a year and, $10,000 in the bank account and invest. And so many people kind of saw this as this paternalistic thing in our securities laws of a lot of private assets like these. And obviously you got to pick the good ones and the bad ones, just like you do on the stock market,
Good apples and bad apples.
Yeah. But they're some of the highest performing asset classes out there, like real estate funds,
And for the most part, it's only the wealthy folks that are benefiting from that historically, because, if you're going to do a real estate deal like this, to your point, there weren't laws. There wasn't a way to raise money from folks. You might have a construction person or a maintenance person or a property manager that really understands that asset really well, and they'd like to invest in that building that they're managing, but they couldn't because the security laws didn't allow it, unless they were an accredited investor, a wealthy investor. So it was kind of a backward system.
Yeah. And we would get that. I remember just as an attorney, I would have people out raising money on a real estate deal, and they're like, I want to get my neighbor in this deal, or my cousin or my college roommate. And I'm like, but they're not accredited and I can't let them in. And they're like,
too bad.
And I'm like, I mean, they don't qualify. I'm sorry. And that's just how it was.
Yeah. And, the other part of this that's important is the technology behind what we do. If you're going to do an apartment building project and you raise money from 10 or 15 people, there's not really a lot of technology needed. It's more of maybe an Excel spreadsheet. And, it's pretty simple, but our current project has over 340 investors on it. When we raised over $4 million, right at $4 million on it. And so we've built a platform so that people can invest online, similar to you might see crowdfunding things online with, people raising money if for an event or something bad happened to somebody and they do a GoFundMe. That's all crowdfunding too. But in our case, it's a real security. You actually are an investor in it, but it's all done online, which really, really makes it possible.
Okay. Let's talk about what you started doing. So, these laws came around, you could raise money from ordinary Joe. You didn't have to go to the country club crowd.
Yeah.
Like tell us like the first deal you did, or maybe one that you think is illustrative of how this worked and came together.
Well, the key thing for us is my co-founder is a real estate developer in the Phoenix area for over 30 years, and he knows it really well. And he's an expert in the field, John Kabrowski.
Yeah.
I did a few little things that I mentioned, but I really focus more on the crowdfunding aspect, fundraising, financial reporting, marketing, digital marketing, and outreach. And so we have a nice team here that we both have our own expertise, and we met in summer 2017, hit it off. He wanted to start he wanted to do more development, but he wanted to open up the investing to a broader pool. And our first project was a small 12 unit building in Tempe. We had to raise $500,000 on it. And we knew the seller, and the seller agreed to give us 6 months to close. And it was a building that needed some renovation work. So that's kind of our strategy. It's a value add strategy. We'll go find these buildings in a good area. And this one's in Tempe, right near ASU, kind of a booming area, but it needed an investment. So we're raising funds to help finance the renovation and to help finance and cover the down payment. So yeah, our first project, we needed to raise $500,000. We thought we'd probably do that in a couple of weeks, and it ended up taking 5 months and 29 days literally to raise that first $500,000, because we had 100 investors. And you have to talk, just like folks on the webinar now, we need to talk to a lot of people before you're comfortable making an investment. That's just normal. So it ended up taking us 6 months to raise that amount of money, and we made a commitment to each other that we weren't going to call our wealthy friends to put money in. Yeah. We knew we could always do that, but we wanted to do it the real way and start to build a real crowdfunding business, which means, finding people, educating them, and a business that could grow. Yeah. So we barely closed that project. We bought it on time, did the renovation. So that was our first project that went full cycle, where we buy it, we renovate it, we stabilize it with new tenants. Yeah. We get it generating cash flow. And at that point, we start distributing the cash flow back to investors. And then 2.5 years later, we sold the building, give us a liquidity event where all the investors get the rest of their returns. And since then, that was in 2017, we've now had 4 projects go full cycle. Our second, third, and fourth projects have now all gone through that cycle, and we've now sold them. We're on our 10th project right now, which is our current one. Yeah.
That's awesome. So tell me, like, the last one you just raised for, how much bigger was it, and how fast were you able to raise for that one in compared to the first one that was $500,000 that took you had 6 months and you barely closed it in with 1 day to go?
Yeah. So this year we've done four fundraisers for 4 apartment projects, and we actually have done a 5th one for a retail project. So we've done 5 total. Earlier this year, we had our first one that sold out in the first 24 hours. We had 180 investors, I think. We give the first 24 hours to our current investors. Okay. We block that off. Then if there's any available, we'll open it up. And that happened earlier this year. That's a project that is actually in Flagstaff, Arizona, a few hours north of us, and that sold out so quickly. And then now our recent project, we hit our target fundraise, I think in 2 weeks, and that was a bigger fundraise for 120 unit hotel to apartment conversion.
Congratulations. A couple of comments. One is, Matt and Mark have a really good podcast that they did on due diligence, so you should go check that out. But one of the things I think is critical for those of you listening, when you're looking at investments, you're looking, you want to do your own due diligence. So you're looking at who are the people behind these companies or these businesses that are managing them, and what are their skill sets. Like Jamison just outlined, what his unique abilities are, and then he went over what his, his co-partner, co-founders' unique abilities are, and how they're a great team. We have similar strengths here at Directed, what we're, all differently, great at. And so I think that's one key piece. One of the questions that I have is, how do people like get started and do this? So we're talking about, it's like, I got 140 investors, I got 180 investors. Like, how do you, dummy it down, if you will, for somebody to like find this, get started on a deal, and how easy, can they hit the easy button and, facilitate something so they don't miss out? Because if it's like 2 weeks, it's like, boom, they got to have an IRA account open with us. They got to have money in that account, and they got to be ready, or they could miss out on the opportunity. That's why we always tell people, first step, get the account open, get it funded so you're ready, to get in the game. So can you give us some color on what that looks like in the process?
Yeah, I definitely agree with what you're saying, because what we end up finding is if somebody comes to our website and they get added to our email list, or they create an account, it takes about 3 or 4 months generally before they place an investment. And we're totally fine with that, because we have a lot of materials on our website, and like Directed IRA, we do a lot of video. So on YouTube, you can find a lot of video, some great videos about each of our projects. We have our podcast. So folks want to come in and do their due diligence. A lot of that's about us as a company, is what we found. We had one investor that told us initially, I really thought that Tempe project would do well. That's why I did the investment, but he's now invested in all 10 of our projects. He said, now it's more about, the team and the vision. And so get to know us through all of those platforms is a great tool. And we try to do a great job with those so that they're informative, kind of educational. And then as you get added to our list, once we have a project, we give you a few days heads up. We say, hey, just look on, typically we launch our projects on a Friday, and we'll send our weekly update on Sundays, and we'll say, look on Friday for our offering. And, we have some investors that have over $1 million across our projects, and we have some investors that have $1,000. And all spectrum of people. We have school teachers, we have firemen, and it's really fun because everybody's treated the same. If you have $1 million in a project, or you have 1,000, you're an owner. And some of our bigger investors, they watched us for months until they invested, and that's totally understandable. But the great thing is, you can just start with a few $1,000s and kind of see what it's like. Yeah. And that's what most people do. And then as it goes, we'll do 4 or 5 projects a year, and you can invest on those next ones.
Cool. Okay. Awesome. It's awesome to see how you guys have scaled up and how many deals you're doing. Even the deals you are doing are bigger, and you're having that success. I think Rick chimed in with a question about returns. I mean, you don't make any promises, but you have had some deals go full cycle. If you want to talk about some returns and maybe some risks too, people should know about as they're investing in your types of deals or others.
Yeah, so we pay a 12% preferred annual return to our investors. So it's a little different structure. A little story here on our first project that I had already alluded to that took 6 months. Yeah, we originally told investors that they would have what's called common equity, and maybe they could make 13 or 14% return, or it could be as low as 6%. It depended on how the project went, right? Yeah. And then we were sitting in a large meeting with about 100 people, and we told them that we were going to actually bring in a third partner we were going to do preferred equity, and we we're going to pay them a 10% preferred return to them, but they would fund a big chunk of it for us. Yeah. And we had an investor who raised their hand and said, well, can I do that? I'm much more interested in that than the potential of getting, 6% or 14%. Can I just get the 10? And John and I kind of looked at each other and we said, well, maybe that would work. And we ended up changing the offering, which was a ton of work midstream. Yeah. and changing it to a 12% preferred return. And so what that means is, as an investor, you're a passive investor. You're not doing the work here, so you don't have a lot of control over it. So we're going to pay you the first 12% out of the gate. And then if we can make more than 12% on the deal, then that's where our profit lies. And we changed that first offering. And once we changed it, we funded the full deal in about 2 weeks. And since then, all of our projects have been that 12% preferred. So it's it's lower risk because it's all preferred. Generally you get about half of that along the way in cash distributions that come from profits of rents. And then about half of it is upside when we sell the building. So you get about 6% a year and about 6% upside when we sell. So that's kind of the short answer there.
Okay. So if I'm an investor under how you structure it, and just so everybody knows, every fund does this a little different, there's a lot of variation out there. So that's an important tip here, is drill down on how the profits are distributed. Is there preferred and common, or sometimes like class A, class B type stocks? So you want to look at that and get a clear understanding of it. So let me ask a clarifying question. I mean, I guess, like, let's say I'm the investor, I'm looking at it, and kind of like the guy that asked you the question, who's like, man, I don't want to make 6%. And then Jamison, you're also making money because I didn't really get a great return on just 6%. But on the other hand, he gave up the upside to get more than 12, because he's like, what if you return 20% on this building? And he's like, I got greedy and I could have got more actually, but I wanted the safety to get the 12 before Jamison made a penny.
Right.
So is that how it works? It's cutting both ways, right? Like they get capped out at 12, but they're also not like sharing in profit with you when they're only making 5% or 6%.
Yeah. And that's a great point. So as an investor, you got to figure out, what is your risk tolerance? Do you want to put a little bit more risk on the table and potentially get more upside? But anytime, and I learned this a lot in my experience on Wall Street, anytime there's potential more upside, there's also some more risk. Those two things go hand in hand, risk and reward. For us, we're conservative operators. We keep our debt very low. We keep our leverage very low. If things turn negatively, we're prepared for that because we keep our debt 60% or lower of our projects. And you can lever up. You could go up to 80% or whatever. We don't want to do that because we're a couple of conservative guys. We're taking an asset that's already generating cash flow. We're going to buy that. We're going to take it up a few notches to increase that cash flow. So it's a lower risk investment. And for our folks, it's more about people who are really happy to get a 12% double-digit return with real estate. Some people will maybe out there, they'll promise you more, and maybe they can get more, and maybe they can't, because that's the way it goes. For us, that's the model that we have, and it works really well for a lot of folks.
Okay, cool. All right. Well, now you do have some debt on deals, but you're signing on the debt if the bank makes their guarantee. Investors aren't having to agree to that, I presume.
That's correct. Absolutely. Yep.
Tell us what's out there right now. And actually, let's talk about, I see the Sam Adams slide.
This is just one of my favorites
of crowdfunding.
Yeah. So, crowdfunding is the modern term for what we use, but the guys, the founders of Sam Adams, when they were doing their IPO, they said, we want our customers, our beer drinkers, who really understand the product, to have the opportunity to own some of our shares. And they did a really unique thing when they did their IPO. They made the investment bank carve out a bunch of shares for their customers. And then when you bought a 6-pack, and this was in the 90s, there was a thing you could tear off, fill out, and mail back from the 6-pack thing and say, hey, this is my name, this is how many shares, and you attach a check and you get shares. And this was basically crowdfunding, and they had over 100,000 checks arrive, which was way more than they expected. The guy ended up saying, I wish we had done like the whole thing that way because we had so much engagement. And this just kind of goes to what we believe. We would rather crowdsource our projects, and we have got so many benefits from that. And I'll just give you one example. Our current project, we're rezoning it from hotel to apartment. Yeah. And we have over 300 investors.
Awesome, by the way. I love that project.
Yeah. And, we took a a hotel that was struggling with all the Airbnb and everything that's happening. This hotel's struggling, plus COVID. It's kind of wounded from that. And then at the same time, we have a big shortage of housing. So we're renovating this thing, converting it over. It's extended stay hotel, so they already have kitchens. We don't have to do any moving of walls or putting in kitchens. They're all there. And when we are in the process of going to the city, we reached out to our investors who are all, mostly Arizona residents. And we said, here's the information for the city. Please send them this, that you support this project. And we have we have 300 people ready to do that because they're investors. So we see it as a value to have more people involved. We've had investors drive by properties and say, hey, what color are you doing this? We think this might be a good idea. And we've done it because, we love taking that information. So it's when you go to this crowdfunding group, it kind of makes investing more fun. Sometimes investing is stressful. You're worried about what you're going to lose. We want to make it an enjoyable process. And at the same time, we're doing all the legwork. We're taking the phone calls when the air conditioning goes out. We're handling all that. But as an investor, it is a bit more fun because you get to be part of the process.
Yeah.
The other one I love, Statue of Liberty, was crowdfunded. 160,000 donations. The government funded the pedestal, but they didn't the government funded the statue, but there was no cost for the pedestal. So there was no way to get the statue up. So New York Times put out this article and said, hey, we need more money for the pedestal. 160,000 donations came in. That's how the Statue of Liberty got put up.
That's awesome.
That's cool. I had some history today, Jamison. Man, you guys didn't think you're coming to history class.
Well, I love crowdfunding. I mean, it's fun to include more people. And that's part of why we keep the risk lower, because we have school teachers, we have firefighters, we have people who are working hard for this, and that's our risk profile. We're capital preservation focused, and we're going to get you a good return as well. But we're trying to limit that risk as much as possible. This is a little bit about our strategy. We're looking in up and coming neighborhoods.
Okay.
Typically buildings that are a little smaller, under 200 units, 10 to 200 units. And then we do this smart, intelligent renovation to them. And our properties almost always are under market rent when we buy them. So just by renovating them, we don't even, we're not taking the rents above market. We just renovate them and now the rents are much stronger and we can get a nice return on that repositioning.
Would it be fair to say that this is these are kind of neighborhood improvement projects too, that become, really valuable to the neighborhood, provide affordable housing for people because we have such a great shortage, nationwide? I know you're really focused here in Arizona, but we have a shortage here as well.
Yeah, we have great feedback from neighbors when we go in and do this work, because we typically are buying what I call the dog on the street. We're happy to do that. And the neighborhood is happy to have us come in and fix that thing.
We have so many jokes we want to share with that. We're just going to keep it to ourselves right now. It's good for us too. So we're not nonprofit. When you can time it and go into a neighborhood and find a deal, and this is what my partner is so good at, is finding these deals that are in an up and coming neighborhood. Everybody benefits there. You've probably seen some of these numbers before, but I just want to remind you, and some of this is going to shift after COVID, but sure.
Millennials and baby boomers are much more likely to rent than folks would have thought, 10 or 15 years ago. And we're seeing that now. And that's why there's been this kind of glut of home buyers, because millennials had never bought homes and now they're coming into the market.
Yeah.
They want to live in these kind of core urban areas, but the attitude around renting has certainly shifted in the last generation to where it's kind of cool to be able to rent, have the flexibility to travel, have the flexibility to move for a job. And that's why we like the multifamily segment so well. And it's really driven by both the millennial cohort and the baby boomer cohort, who are saying, let me sell out my house and get my equity, cash out, start traveling more. And I don't need this big house. I can live in a nice apartment downtown and have that flexibility.
Yeah. And let me just hit some of these high notes on the slide that's being shared. And this is going to be recorded. And we'll have the slides available for download. Those listening to this on just the audio version, we're going to do a special podcast episode of this to share too, is you can see the percent of households who rent their home. For those of you that are investors in real estate, single family rentals, looking at multifamily projects like Jamison. I mean, these are really interesting stats. Like the percentage of households who rent, I'm just looking at Jamison's graph, is 37% in 1960. It went down to 31 of renters in 2010, but now we're back up at basically 37%. So all those increases in home ownership and people owning a home that happened over 40 or 50 years have now been evaporated in the last 10 and is back to a larger percent of people that rent, which I think is actually fascinating.
And what we're seeing in places like Phoenix is a lot of migration, 100,000 people moving here to the Phoenix metro area every year. And in prior cycles, they could go buy a home out in the suburbs, 50 minutes from downtown for an affordable mortgage payment. And those home builders are not building the way that they used to. They're buying a new home is, there's a lot less inventory, and we know inventory in general is less. So these folks need to live somewhere. And that's why we continue to think that multifamily is a good spot to be in for another, 10, 20 years. It's not a short-term thing. And we saw what happened with COVID. All the other real estate assets struggled for various reasons, and multifamily did so well. Folks paid their rent. They got to have a roof over their head. They paid their rent, and we weathered it very well.
That's why I love, self-directing your retirement account to get in an opportunity, like this, that, relatively small dollar amount. And you're improving a neighborhood, solving a solution. It's just cool.
Yeah.
Anybody can do stocks, bonds, and mutual funds, but to find deals like this that are actually impactful in serving the community, that's pretty cool to do.
Yeah. And we have a big team. We have our own renovation team, which, we're having our holiday party this Friday.
All right.
And we have, those guys and gals do so much great work for us, with us. And it's a lot of work. We're sourcing materials constantly with everything that's happening. We're putting in new appliances, and we're waiting on those. We do an excellent job. And part of that's because we built an in-house team to do that. So what we do, it's a lot of work. It's some heavy lifting. You need to have that expertise. And I'm glad that we, have a great business partner, co-founder who runs that side of the business.
Let me pause there, because I just want to do a couple of takeaways on that. I think it's important because we see, this is back in my days as an attorney, I would get clients that are where I would actually advise them on deals from just a legal or due diligence standpoint. Now we don't get into that. We have issues obviously with directed IRA. You self-direct your account, I'd have clients come and they get some private offering, or, it could even be a 506C or something back in, and they'd be like, well, how should I invest in this? I'm like, well, I don't know. I mean, what do you know about the person raising the money? And in the real estate, you need to have deal flow. You got to have good deals. You can't just be this is a guy who's doing his first real estate deal. He's going to get lucky and hit a home run right out of the gate. No, you got to find a guy that has deal flow. John, in your case, right. You got to be able to get the money to pull off the deal. Right. And that's, Jameson, you've figured that out through, how you guys raise in your particular method. But you also, have to have a strategy and the ability to execute it. So if you're doing a value add thing and you're going in and tearing stuff out, think how competitive it is for someone that doesn't already have a team built to go build a team that could go renovate a 100-unit deal right now. Mm-hmm. Oh my gosh, could you imagine how hard it is to get contractors and stuff lined up for that right now? It is so competitive out there. I don't know where else is that, but in Arizona, yeah. So there's a lot of things that come together, I think, in executing, particularly on a real estate deal. And as you're looking at due diligence, you want to be able to think about that. Do they have the right deal flow where they're going to get the right deal, that I know this is a good deal? Or they have the ability to raise the money, not just from me, from other people. You want to look at their track record. And also, can they execute on the strategy that they have? Like, they might have a pie in the sky strategy. You want to be able to drill down and say, well, how do I know you can execute on this?
And we're very picky about the deals that we take. I ran the numbers kind of rough back of the envelope, and I think it's about 3% of the deals that we see that we pursue. And it might be 1% that we actually move on. We're really picky. You make your money in real estate at the purchase. And so you got to buy it right. If you buy it right, then you do the other right things, you can do well. But if you buy it wrong, it's really, really hard to make money in real estate. So we're really conservative. And
they really always say, I always love the quote, you make money when you buy real estate, not when you sell it.
Always.
Yeah. You make money when you buy. Let me ask this, Jamison, about, where you put your deals, or where people can just find deals like yours. I think you have one on a crowdfunding platform right now. Like, where can people go to learn more about your deal, or even just other deals that are out there? So they're like, oh, can I find some of these types of offerings? Yeah.
So we've only raised our first 10 projects. We're only with Arizona investors, but our current project is now open to national investors. And if you go to our website, neighborhood.ventures, you can see our projects, our properties page. And if you're not an Arizona resident, it will send you to the offering that you can invest in. So definitely reach out to us, because we have an open offering. It is hard to find good deals right now in good markets, because similar to what's happening with single family. And but we love the idea where if somebody wants to ultimately own their own apartment building and apartment portfolio, come and work with us for a little while, invest with us, see what we're doing, and then maybe you end up buying one of our buildings. Who knows? Like we're not territorial or look at it that way at all. And we are actually, our 2 deals ago, we sold that project to an investor because they had followed it the whole way through. So, obviously, just like anything, you learn the most by doing, and by investing with us is a good way to just start going down that path.
Okay, cool. So what's the, I think some of these questions came in. I know one of them was about an investment amounts. We talked about how it doesn't take 50. Like, what's the average someone invests with you? Maybe some average you see with someone with an IRA. What are some of those numbers you see, and maybe hit even the minimums? Yeah.
So our minimum is $1,000.
Wow. So when really you were saying you could even do it for $1,000, that was literally $1,000. That wasn't just like maybe $1,000.
That's right. So 1,000's minimum. Our average is 5,000. So, over 10 projects and I think it's 1,500 investments. Our average is 5,000. Most of our investors now are repeat investors. And so our average investor has about 25,000 invested with us over multiple projects. So, it's across the board. And, I think the bigger investors really, they've started smaller with smaller amounts, and then they just keep investing more because they get comfortable with what we do, our strategy, who we are, how we report. I'm really, coming from the public company background, our financial reporting is really tight. It's really important to me that that's all done correctly. It's done on time. And so our investors are always getting that information before they ask for it. We always just say, hey, every month they're going to get an update from us. Every quarter we do a webinar and we give detailed financials. The thing with crowdfunding is it's super transparent because it's required that it's transparent. So everything is there. And we don't have investors calling saying, hey, what's going on with that project? Because it's all there. We're putting it out all the time.
Now, isn't there a max on crowdfunding on the federal rules? Is it about $100,000, or is that
if you are
individual?
It depends on if you're accredited or not. Now, if you are accredited, there is no max. Okay. That's a recent update in this last round.
Let's say someone unaccredited, they're like, I got 200,000 net worth and I make $70,000 a year.
Yeah, you can invest 10% of your yearly income or 10% of your net worth, whichever is more.
Okay. So
So
that
that person
example I
could-
gave, they had 200,000 net worth, they could put in 20 grand.
20. Yeah. Yeah.
Or they could do, let's say they had nothing, they had zero net worth, but they made 70 grand, then they could put in seven.
They could put in 7. Yeah.
Cool.
And when you go in and invest, it's very simple. They ask you a few questions. You just put that information in, and then it'll tell you how much you can invest as a maximum. And you can say, oh, I could do 7, maybe I'll do 7, or maybe I'll do 5. And so, yeah, that 10% is kind of the magic number, is 10% of your income or net worth.
Okay. So I'll tee us up for some Q&A. The website is neighborhood.ventures, not neighborhoodventures.com. It's neighborhood.ventures. We've had lots of people go to neighborhoodventures.com and they're like, it's a seafood place. It's neighborhood.ventures.
Yeah.
Okay. So the group, as far as the exit strategy goes, is it always to sell the property, or are you holding them? We've got a lot of people asking that.
We always sell the property, and we have a target hold period, either 2 years or 3 years. And I think you had that slide up a minute ago, but we've always achieved that. That is a target. So let's just say, worst case scenario, something were to happen, we may end up holding it longer than that.
Okay.
But our plan and our confidence is that we can do it in that amount of time. Let's just say a 3-year project ended up being 3.5 years. You're earning that 12% annually. So if the project is longer, most of our investors, when we send them all their principal and their returns back, they say, well, do you have another project I can put this into? And sometimes we do, sometimes we don't. So most folks want to keep that money working for them anyway. But it's a project at a time. So you get that liquidity when we sell it. All your money comes back to you, plus your upside of your returns.
Okay, so let's hit on the returns, because we have a number of questions that are centered around that. The 12% preferred return, is that distributed annually, quarterly, at the end of the term? Is that an annualized return? I know I'm just throwing a bunch at you, but you get the gist of what the questions are. Yeah.
So that's an annual return. We use the IRR calc in Excel to determine that. So it's not a straight, interest return like you would if it was a loan. It is a IRR return. So it actually calcs a little higher than just your typical straight return as if it was a loan. So that's good. Typically, you will get about half of the return, 5 or 6%, in distributions. And then the other part, for the other 6% for that year, you'll get paid at the end. So you're earning 12% every year. And we don't send distributions out to folks until the property is generating cash flow. Okay. Sometimes that cash flow comes in month 3. Sometimes it comes in month 6. Sometimes it has come in month 1, because we have had one project where we didn't have to do a lot of renovations. So that going in, when you'll start receiving the 6% in distributions, and we pay it every month. So you get a direct deposit every month, or it comes into your cash account every month.
And then that 12%, when you say at the end, is that the end of 12 months or the end of the project? The end of the project, once we sell it. So essentially, the way to think about it is we can make about 6% in a cash return, and we're sending all of that back to investors. We as a company, we don't keep any of the profits along the way. We send it all to investors. The other 6% that you get is upside in the appreciation, that when we sell the building, now there's that appreciation. Now you're getting that other 6% there. Okay. Yeah. A few questions. Do you have to use a retirement account? Can you use personal funds? Can you use crypto? I got somebody that just asked that. Will you accept Bitcoin, Jamison?
We don't, but maybe someday. Some crowdfunding you can do with Bitcoin. Actually, you can do with a Visa credit card. It has to come out of your checking account. We don't want people borrowing money to invest in us. So.
Obviously you could always sell your crypto. Yeah. You'll have tax, you got to gain, and then use the dollars to invest. But
yeah, you can use an LLC. If you have an LLC for investment purposes, or if you have an LLC as part of your IRA, you can use a custodial IRA with directed IRA or another custodian. You can use personal funds. You can use your trust. We do all that.
Okay. Here's a good one. Just, you don't have to go into all the specifics of it, but what are the key elements of due diligence that you're doing on a property? Because you said you turn down, 97% of them, and you usually look at like 3%, and then you'll select a property. So what are some key elements you look for?
Well, so we have a key relationship with the largest multifamily broker in Arizona. My business partner owns that company, started it. He's not an active broker there anymore, but he still is the CEO.
Okay.
And so we get a lot of deal flow. We're looking at deals every day. And we get a kind of a first gauge is let's look at it. Let's look at the numbers, back of the envelope sort of analysis. Why are they selling? What are the comps? All of those things you can do from your computer, and that crosses off a lot out of the gate.
Yeah.
If that makes sense, then we do a bit more underwriting analysis where we say, what could rents be? What would the renovation expenses be? Where can we take this thing? And at that point, if that looks good, we'll try to tie up the property and make an offer on it with a letter of intent or an offer. If we get an accepted offer at that point, then we'll go out and tour it. And so we toured a property on Wednesday, last Wednesday, and we had it under contract. And after touring it and getting all of our inspection information back, we decided to not move forward with the project. And I think it's probably at that point, once we get them there, maybe half of those deals we end up moving forward with. So each one, each phase of our due diligence is a kind of a filter until the ones at the very bottom that get out of it, they've gone through a really rigorous process. We take a team of about a dozen people out there, and we're going through every unit. People living there don't love it, but they get a 40-hour notice. We want to see the whole unit. We want to see every unit. We want to see the plumbing. We want to see the pool. We want to see the boiler. Everything. Yeah. I bought a home this last year, and the due diligence that I went through, I was like, man, I did a very little on my own home compared to what we do with an apartment building. I should have been more analytical, but
funny how that is.
And then it's a financial side and the actual, you got to get on the property and see it.
Okay.
And yeah.
Can I participate if I live in any state? Do I have to live in Arizona?
You used to have to, but our current offering, if you go to smallchange.co and you click offerings, you'll see our offering on their portal. This is the national crowdfunding portal. And so this is the only offering we have open right now, and you can invest in our project right there.
Awesome.
Yeah, and that's for unaccredited or accredited, right? So
that's right. Yeah.
Awesome. Okay. Well, I think we did good. I think we did good on the questions. Those were good.
Oh, this has been great. You guys have some great questions.
Jamison, this is awesome. I love the projects you're doing and to see the growth you guys have had. I know we've had clients, IRAs over the years, invest in your stuff. And I always love, I've been to some of your events too. And I love seeing you have a community of people that come out and that are invested together. And it's just everyday people. It's not the boring, stuffy country club crowd, which is, I think you just built something cool. That's all I'm trying to tell you.
No, and after working on Wall Street, I was not interested in making wealthy people hedge fund managers. When you make hedge fund managers $1 million, it doesn't matter. But, I think folks who like me, I'm trying to build my own IRA up to, $1 million one day. I'm not there, but we love to help folks who are more doing the right things, putting money away. This is a good place to put some money, and we're going to work hard to give you a great return.
Awesome. Well, we really appreciate you joining us, and thanks everyone for your good questions. And again, you can go check out neighborhood.ventures. The easiest way to get started is just open an account at Directed IRA. We have a sweet promo code to get $50 off. You can use it anytime. It's good. It'll waive the new account establishment fee. Get that account open, get it funded. We got the documents already from Neighborhood Ventures, and you can get going with as little as $1,000. So
we're working with you guys basically every day with different investors who are investing with you. So, and I love your platform. I have my personal account with you too.
We appreciate that.
Yeah.
You're not only it's like, I would be a very good spokesperson for the Hair Club for Men, you know. I'm also the president of the Hair Club, but I'm also a client, but you know.
Yeah, it didn't work out.
You win some, you lose some.
Yeah, well, appreciate Jamison. Again, we'll have the recording up. If you missed any parts of this or want to watch it, we'll have the slides available. You can download. You'll get to directedira.com/webinar. And if you're catching this on the podcast episode, just get over to the website, directedira.com/webinars, and you'll pull up all the prior webinars, and you could grab the slides for this, there's some great slides and data in there as we were going through the presentation today.
Awesome.
All right.
I think we're good. Thanks, Jamison. Thanks everyone for listening in, and rock and roll.
Yeah, rock and roll.
What do you got?
Stay calm and self-direct on.
All right. You got one first, Jamison?
I can't top that.
By the way, we had mugs made with all these little slogans. So
we'll send you one.
Yeah. So we'll send you one.
Thank you.
Later. Thanks, everyone.
Thanks.